All right, and we're live. Welcome to Non-Dilutive Financing, hosted by Chase Christensen of RBCx. I'm Zach Storms. I'm just here to introduce your co-host today, Chase from RBCx. He's put together three great panelists. RBCx is a longtime and BFF sponsor of Startup TNT. And so we're really happy to have them here today. Thanks everybody for joining us. You can post questions in the chat. Let's make this interactive. We're going to hear from all of our panelists. We're going to dig into different parts of non-dilutive financing with a clean tech focus. And so without further ado, Chase, over to you.
So yeah, thanks, Zach. Thanks everybody for showing up today. I know we're pretty excited to dive into the panelists or into the panel discussion here today. I'm joined by three great colleagues across the clean tech industry, specifically Peter MacArthur, who's, I won't spoil their backgrounds too much as I know they're all experts in the field, but Peter with RBCx, Jean-Luc with BDC, and Jennifer with SDTC. And with that, I'm gonna let them talk, they're the experts. And so I guess we can start off passing it over to Peter if you wanna give about 5 minutes of your overview, what RBCx and clean tech's about, and then we'll move on.
Awesome, Chase. Great to be here today. I'm dialing in from Ottawa, where it's probably not as cold as Edmonton, but it's snowy, which I like. So yeah, Chase and I both work at RBCx, which is a group of about 700 people providing a platform solution for technology-related companies. We're on the banking team, but we also have a capital group, a ventures group, and a full platform team. I just want to give you some context because when you think about bank, you probably don't think about something like RBCx. So it's worth just giving a little bit of background. So our capital group works with venture capital firms. We provide banking solutions and we act as a limited partner. So we invest in some VCs. And I'm pleased to say that we've invested in 5 venture capital firms across North America, 3 of which are in Canada. So we do just some equity, but really I'm here to talk to you about debt. Our platform group provides operational expertise and assistance for our clients, something you wouldn't normally expect from a bank. So if you reach the right stage where we can bring them in, they might help you with, I don't know, dealing with media, some dev requirements down the road. And also we have a marketplace with incentivized services through our platform group. So if your cap table gets a little bit wacky, we have a cap table provider that has incentivized solutions for you, or AWS discounts and things like that we give to our clients. So I don't think these things are what you normally think of when you think about a banking partner. So it's a little bit unique. And then our largest group is our ventures group, which incubates a variety of early stage technologies complementing banking solutions. So don't think we're competing with you. Maybe we are, but and I'll give you 2 examples. One of them is called Mido, and Mido is a solution to help if you've got kids, trying to educate them and provide financial literacy as you think about allowance and how do you manage those sorts of things. Mido is a solution to help you deal with that. Owner, very applicable. You want to get incorporated cheap and cheerfully? We've got a solution. I think it's about $50. Can help you get incorporated, get the business up and running, along with other related services. Don't have to be a Royal Bank client. Doesn't matter. You might want to, and there's a whole bunch of related things. So there's about 100 of us that work on the clean tech or work in the banking group. And we're the part that offers traditional and some non-traditional banking services. I'm going to talk a little later about what those, some of the lending, non-traditional lending things or options we have. But generally, Chase and I don't like to talk about products. We want to do whatever we can to add value to our clients and become their trusted, valued partner. So whether it's connecting them to smart, capable people like Jennifer and Jean-Luc or other parts of the ecosystem, our job, our role is to be someone you can come to, talk about your business, your path, your growth, and are there resources we can help bring to help you do that. So I lead our Cleantech practice, which consists of 10 specialists across Canada, like Chase in Edmonton, Danny in Calgary. I think I saw her on the line here, two of our professionals. And so we are deeply plugged into the Cleantech ecosystem and draw on this ecosystem to help our clean technology clients to flourish. We've been working with clean tech companies in Canada for over 10 years. I believe we're the only Canadian bank with a clean tech practice coast to coast. We have approximately 200 companies in the space. And again, we're providing advice, banking services, and debt, just to get it straight, whether it's debt or equity that we're talking about. Thus, our participation on a non-dilutive panel. I'm going to stop there and pass the torch to whomever's next.
Awesome. Thanks, Peter. And I mean, you say the only bank, and this is why we consider BDC and Jean-Luc over at BDC to be friends. So if you want to go next, Jean-Luc.
Yeah, you bet. We're the other bank that has clean tech, but we don't do deposits. We don't do the same thing that RBCx does. We really are a commercial financing partner, helping businesses achieve the financing, the capital at that early stage, and really all along the stage. So I work with the BDC technology financing team, and that stage where we try to help companies is between the pre-seed all the way to that Series A, where you're really trying to scale your operations, commercialize, really trying to boost your valuation so that you're going to sell at a place where you want to, right? Not before you have to, not having to say, okay, well, this company needs to keep going. I know there's something here, but we need to go get capital from multiple investors and sell off that percentage. And maybe that works if it's a really good partner, right? The ones that can help you do that growth. And that's where we come in on top of that and provide additional runway. So we're really working with cash burning companies who have high growth profiles, right? And it really doesn't matter at which stage you are, as long as it can fit within your financials, because it is debt for what we do with non-dilutive. It will come due at a certain time. But when you have that eyesight on, okay, we just need this capital to get to that inflection point where we become sustainable, that's the perfect time to have a conversation with us. Because even if it's not today where we can come in, as Peter said, we really do try and connect you to all the different parts in the market and be a bit of an advisor and just make sure you can uncover every single stone on your way to that, on that capital raising journey. So it really is exciting to get in there at that early stage so that you have it as a part of kind of your capital raising journey. You have this tool set in your tool belt, right? And you know when you can come to us and start making that non-dilutive journey with debt. And aside from that, once we have those, and maybe you grow with us at BDC, there's a lot of other avenues that we can go. There's our growth and transitions team. We also have a lot of venture capital firms. We have our women in tech fund. We do have a clean tech, industrial clean tech, and we make those introductions when the companies are able to, be a part of that table and are ready for that level of investment, right? So, I don't have, too much more than that, Chase. So I won't take up the full 5 minutes, but it'll be really exciting to talk about all the different questions that come up on this. So thank you.
Awesome. Thanks, Jean-Luc. And then would love to pass it over. I mean, everybody's favorite clean tech group, SDTC. Jennifer, if you want to give just a bit of an overview. I think you have a presentation to share?
Yeah, I do. All right, can you see it, everybody?
Works for me.
All right, great. Thanks for having us here. So I, myself and Camilla, who's also here representing SDTC, Sustainable Development Technology Canada. So we're the largest funder of early stage entrepreneurs in the clean tech space in Canada with non-dilutive funding. So we do have a team across Canada. So myself, I'm located in Calgary and I cover the Western provinces, so Alberta, BC, and Yukon. And then we have Camilla who covers the other side of the prairie, so Manitoba, Saskatchewan, and the northern provinces. And we do have team members throughout Canada. So we try to cover all points of the country. And our ecosystem leads, our job is to recruit companies that would be of interest at SDTC, would be eligible, that would meet our mandate and eligible for our funding streams. So just a little bit about our national impact. So we have funded several companies over the years. We've been around since for 21 or 22 years. In our past fiscal year, we funded 64 seed level projects. So that means early stage projects through our seed funding stream, which I think would probably be the most interest to the audience here. So our seed funding stream is for early stage companies looking for initial injection of cash for startup. So last year we approved 109 total projects, including 45 startup and scale-up projects. And we do have a goal of increasing our funding to women-led companies. And so we did achieve that with 41% of our seed fund companies in the past year were led by women. Just a quick note on our investment impact in Alberta. So we have a number of projects that are active in Alberta at the moment, and you can see there's some example companies here on the right that we have funded in the past, and they're active with us at the moment. So a lot of them some of them did come up through a seed fund and then graduated onto our startup and scale up. Some of them went directly into our startup scale up funding stream. So just a bit about our funding stream. So as you know, SDTC does provide non-dilutive funding, and we have 3 funding streams. So we only fund Canadian small, medium-sized enterprises. So they must be a Canadian controlled corporation, which means we don't fund subsidiaries of multinationals. So we are looking to support like Canadian homegrown innovation and technology through our seed and startup and scale up fund. So our seed fund eligibility is for, like I said, those early stage companies. You must be nominated by one of our partner accelerators in Canada to participate in that. So it's a competitive process. You're nominated by an accelerator, and if you meet our eligibility criteria, then you are invited to pitch to our jury. So it's similar to a Lions Den types, or it's similar to Startup TNT, where you have like a 5-minute pitch to our jury, and they make a decision on a fund or no fund. The maximum funding amount is $100,000 through that seed fund stream, but companies do need to bring at least twice the amount of requested funding through private equity sources, not including funds from friends and family. So we have seen some companies that got equity investment from Startup TNT be nominated into our program, which is great. So we want to see those companies coming into the seed fund. So the seed funding stream is designed to be quick. So from application to approval in 8 weeks, that's our goal. So just a little note on our startup scale up funding stream. So we do have a funding stream for later stage companies. They also must be Canadian, smaller, medium-sized companies in Canada. And all of our projects throughout, so seed fund, startup, and scale up, they all have to bring significant environmental impact. So environmental benefits. So we only fund companies with technology that's providing environmental benefits, and also that owner of exclusive rights to their intellectual property. So that's where our innovation comes in. So we do look for those novel, innovative ideas that need support to move towards commercialization. So for a startup and scale-up funding stream, companies do also need to bring a commercialization partner with them. So somebody's going to validate their solution in a market setting. There's other criteria, which if you're interested in learning more, you can contact myself or Camilla at any time after this. So this is the process for this is a snapshot of the process for the startup and scale up funding. So there is a 3-step process: initial application, video presentation, and detailed proposal. This process takes between 6 and 8 months. So the non-dilutive funding that you can get, so our average in the past few years has been about $3.5 million for project sizes in the $10 to $12 million range. So companies that are looking to capture further market share in Canada and to further scale their technology and innovation. So here's a few companies that we have funded in the past few years through all 3 funding streams. You can see there's probably some familiar names in there to everybody here on this meeting. We also, so SDTC is really committed to supporting entrepreneurs and innovation in Canada, and we have the seed funding stream, which is to support early stage companies that meet our mandate. But we also, we do provide long-term sustained funding to support emerging companies. So there are opportunities to be supported through the seed fund, and then as the company progresses to be supported through our later funding streams. We do recognize that a lot of technology commercialization can take a long time. So this information is from our research that we've done at the companies that we funded over the past 20 years. We do understand it can take 13 to 15 years to fully commercialize technology in Canada. So just to close, this is how you can connect with us. You can connect with us directly, or you can go to our website and fill out our online form. So there is a button right on our main page where you're then brought to our form where you can put in some information, and then you'll then be contacted by someone from our ecosystems team. So I'll just leave with some of our contact information. Apologies, I didn't put Camilla's information in there, but that's so Zoe and I are both in Calgary, and I can and you can reach out to myself or Zoe or Camilla if you want to learn more.
Awesome, thanks, Jennifer. I know if you've been on LinkedIn over the last 2 days, SDTC has been the talk of the town with a pretty substantial amount of capital deployed in the Alberta market. I mean, notably here in Edmonton, you see Aurora Hydrogen, you see Future Fields, so some fantastic announcements and partnerships. One thing I wanted to, because we'll hop into some of the panel discussion part of it now after everybody's given a bit of an overview, but I would even love to take a step back and just throw it out to each of the panelists. What does non-dilutive financing mean in each of your minds from each of your practices, and how do you deploy that into the field in terms of products, things like that?
Happy to start here, Chase. So for us here at BDC, non-dilutive just means hanging on to that ownership of your company for us, right? So hang on to that, 25, 30% when you're at that early stage, when you're not at that valuation. So it lets you kind of grow with that without diluting the one thing that is going to be worth the most at the end, right? And that's not to say that you shouldn't be getting these investments, right? Because as I said earlier, there's so many partnerships and a lot of VCs and a lot of investment partners like TNT who are going to help you, make you get many more introductions for your next raise, right? So there's always that conversation you have to have between, should I go non-dilutive, or is this going to be a really strong partnership for me? And for the most part, you're going to actually be able to do both, because when you go out and get some capital raising, some investment, it's much easier for us as non-dilutive debt partners to come in and say, oh, look, you've got people backing you out there. That gives us more credence to come in too, knowing that a year or two down the road, when more capital is needed, there's going to be multiple people coming up and saying, yes, we want to do this. So that's kind of how we see non-dilutive. While it is a strong benefit to keep things non-dilutive, there's also, a lot of strong points to go the other way as well.
That's a great definition, Jean-Luc. I might just add on the dilutive side, just to be clear, we're talking about people taking equity in your business. So the non-dilutive stuff is something that doesn't do that. And, each has its place. The dilutive stuff, incredibly patient, right? Could be there forever. The non-dilutive capital, if it comes in the form of a grant, can in essence be free so long as you qualify. But the non-dilutive in terms of debt, there are some strings attached, and it's important to understand what those strings are and how patient can that debt be. We in the commercial banking world, debt often means a revolving credit facility, something that fluctuates. So it could be credit card, it could be an operating line of credit. So I just thought I think we've got it, but what did we miss, Jennifer? Anything?
No, from SDTC's perspective, of course, we provide grants and non-dilutive funding. So we do that. The purpose of SDTC is to support Canadian entrepreneurs and help keep that technology here in Canada and help develop the IP out here. We often see, or companies come with us with also equity financing, which is a very important part of that, total investment package or your total project costs. but yeah, so we often see that, and we encourage that as well, because it also shows us that there's market value, there's market interest in your product or service, and that there is investors out there willing to invest in your technology.
You
No,
might
awesome.
you might think non-dilutive or is just the way to go. And I would caution anyone who's thinking that, because the dilutive gives you patient capital, whereas what we're talking about are different forms of capital that have real roles. But I think the whole group of them makes sense.
No, absolutely, and I would completely agree. I think it's the balancing act of all forms of capital coming in. And so really, say if a company that's on the call, a founder on the call says, I would love to pursue non-dilutive financing, at what stage should they be coming to speak to any of the panelists on the call? Is it going to be gated behind TRL or level of dilutive capital that they've got? Where do each of your solutions really start to open up?
I can take that. So for SDTC, like I said, we have 3 funding streams. So seed funding is for early stage companies, and we don't use the TRL levels to define when somebody's ready to come to us. So for seed fund companies, they're, like I said, they're early stage, they might be minimum viable product stage. And they're looking for that additional funds to just move their company forward. It's a maximum of $100,000. So it's not a lot, but it's the appropriate amount for your stage. But we also expect that they have at least twice that amount in equity finance investment. So it's like that is where you are in your company's development. And for a startup and scale up, it's like that we have pre-revenue companies that are looking to do their first demonstration. So it's really the company stage that we're looking at. And for scale up, it's like you have done a commercial demonstration, you're looking to capture more market share or even scale or innovate further. So, there might be a gap there where we can't play, but like it's certainly there's a lot of development stages where a company can come to us, provided they have the innovation and environmental benefits associated with their technology.
Yeah, and I'll continue on with BDC, and I'll echo that we also don't typically look at the technology readiness level. What we'll look at for the way we're saying is if this is being adopted in the market, and the best way to see that is revenues, right? That means someone is willing to buy this and they're willing to continue to buy it, and that's really when we start to get involved and we look at trajectory of it. And for us, we can come in pretty early. I've worked with companies that are in their first 500K of revenue, right? But we see that growth, and we can see that the dollars that we're going to give them is going to increase that revenue level, right? It's going to go directly towards that. And Peter had a really good point before. Debt isn't as patient. While we offer principal deferral from 12 to 24 months, if we end up at a point where the technology isn't ready at the end of that, well, then you're in a situation where debt is due, but you're not making the operating profits to pay it off, right? So that kind of helps into the mix as well of, someone asked a good question of what is the healthy mix, right? Well, it is really going to depend on your company in that stage. I'm sure we'll get into it a little bit more too.
So just to give you the RBCx version, yes, we too don't really think in terms of TRLs, but if you do think in terms of TRL, I mean, TRL 7 is when you got the prototype and you're ready to do something, and it's sort of that and above where you start to see revenue. We do have a couple solutions that can be at that stage or a little bit below it. Credit cards, shred finance for companies that have got a 2-year track record of doing shred successfully, maybe. And some Cleantech companies have very long paths to commercialization, so it can apply. But generally, like Jean-Luc, we're looking for revenues to be part of the equation. Although we have we have lots of clients that are pre-revenue. It's just we might not be lending to them, and or if we are, it's quite modest.
And I just want to add one more point too, because we do have some pre-revenue as well, but often in those cases we're also seeing whether it's contracts that are coming up or purchase orders where we can see, okay, the money again that we're giving is going directly to revenue generating activities, and some that are already for certain because they're in contracts and master service agreements. So those are other scenarios where we can come in too at that very early revenue stage.
No, fantastic, everybody. Well, and so for the companies that are looking to deploy non-dilutive financing, are you looking specifically at the projects themselves, or are you looking at financing the company? Say if they have a demo plant out in Leduc or in Fort Saskatchewan, do you look at that pilot project itself or at the entire economic picture of the company?
I can start first. So for the SDTC, you have to apply to SDTC with a project scope in mind, with associated budget and timeline. Of course, when we do our due diligence for our startup scale-up funding, we look at the company financials, financial health, their runway, their cash runway, and their other sources of funds. So it's I guess both of those things, but we do fund project scopes, not companies. Per se, like for company growth, that they have to have a project in mind.
Lots of government programs have a project orientation to them, not just SDTC, and it is helpful to have that in mind. So at RBCx, we're generally not doing project finance. We could do a contract, but we would be looking at the overall health of the business in its entirety, not just that particular project. So we'd want to know the overall cash flow, revenues, burn, some of the other metrics we'd be looking at.
Yeah, and similar here. It's really a bit of a hybrid where we do also project scope, where we see, okay, if it could be we need to raise $1 million in capital to get to sustainability point, and out of that $1 million, maybe it's part grants, some non-dilutive grants. Maybe you've gone out and got a lead investor for 350, 500K, and then BDC comes in for the remaining portion. So that's kind of how we would look at a project and saying, okay, you have the money you need to get to where you say that it will get you, right? So we'll look at it that sense, but we're not just blindly looking and saying, yeah, okay, the project's fulfilled, we'll go. We still do the same analysis. We look at the forecast, we go into the unit economics just to make sure that as you think the company will scale, we think that's reasonable and there's logic there. Now, obviously forecasts, they always change. The world changes so quickly, but we really like to look at the logic. And if we know that and we can see that you can understand your business and see how it scales, that gives us a lot of support to come in and provide it at that earlier stage too.
No, that's fantastic. Well, I mean, I would love to also throw it out there. If anybody does have questions, if you want to, feel free to raise your hand or type it into the chat. Would love to take some audience questions as well. But jumping into the point you just made there, Jean-Luc, I think it's very valuable. I think TNT does a great job of helping people understand what the due diligence process looks like, what investors are really looking for when you're looking for that dilutive capital. And so I'd love for each of you to speak on what that due diligence process looks like for each of the organizations when you're looking at funding a project, when you're looking at working with a company.
Sure, I can start. So we have two different processes for our seed fund. For our early stage, we do require that our applicants are nominated by accelerators. Once they are nominated, our due diligence really focuses on whether or not the technology is innovative, if it has environmental benefits. So we have our own internal technical, like our own staff look at that, and we're all knowledgeable in that area. And then we also look at the equity investment. So we require subscription agreements that that show that the equity investment is there. We also look at the team and also just the company, like holistically in terms of what they put together. So the due diligence for the seed fund is a bit of a light touch because we require equity finance. We expect investors to have done some level of due diligence on that company. So for the startup and scale up funding, it's more involved. So they do have to submit a detailed proposal, which is a long, detailed document to SDTC. So in that due diligence, once we receive that, we do confirm the financials. So the other sources of funds, who the commercial partner is. So we confirm that. We also do financial risk assessment and an assessment environmental benefits, and confirm the innovation. And we do get external reviewers to review that proposal for us and provide recommendations. So all that is put together to form a recommendation to our board, who is the final decision maker.
Maybe if I can jump in after Jennifer, because I want a good segue. There's I think it's 200 scientists you have at SDTC, Jennifer, that help look at the technology and tech test. So, at RBC, we don't have those scientists. So when we see someone like SDTC, ERA, IRAP, who have scientists on staff and vet, it's a huge tick box for us in terms of the science being tested. And it doesn't mean it's going to work, doesn't mean there's going to be product market fit, but there's scientific verification. So we love seeing SDTC as a partner with a company. I can tell you that for sure on our due diligence. From a informational point of view, I can tell you what it is we're looking for, but really my very best advice to early stage companies at startup TNT, so a lot of you are probably in the startup phase or along that path, is to have someone on your staff who speaks bank. And it's unique. And often, we think that, I can figure out a balance sheet and income statement. But honestly, the depth and the integrity, I've received proposals where the balance sheet didn't balance, where the income statement didn't reconcile to the balance sheet, and it's just information that we can't rely on. So I know that not everybody early stage can afford a full-time CFO or controller, but there are lots of good part-time CFOs that companies can reach out to. So I would really encourage the companies that are listening in today to connect with someone like that. I'm sure that Startup TNT has got connections. I know Chase and Dania do. But I call it speaking bank, but you call it something else. In terms of the information that we're going to look at, we of course want to see your deck, we understand the business, the people, probably the most important thing we look at, have the people behind the company, be it you, the entrepreneur, or be it your advisors, successfully commercialize something before, seeing who's around that ecosystem of that company and providing it support has a huge impact in our understanding of what you're doing. As a lender, we have to stick our necks out. And so believing in the people is incredibly important, and developing trust with those people is incredibly important. So being straight is part of the due diligence. We have to make judgment calls about, does this business make sense? Do the people behind it, are they telling us a straight story? So that too is part of the due diligence, a gut check, so to speak. We'd be looking at historical financials, current financials, and forecast financials. And even if you're in a burn mode, even if there's no top line revenue, and you're just showing us expenses, if we can see where those expenses are going and where the expenses are occurring, is it all R&D or at the marketing stage? How are you ramping it up? How are you planning to fund that ramp up of expenses is incredibly valuable to us. So hopefully that's helpful.
Yeah, and before I go, I just want to make sure Zach doesn't have a question because I see his hands up there. But if not, I'll just continue.
Guys, I want to make sure we answer the audience questions because I know that Chase can't see the chat right now, so that's okay. So Chase
Sure.
and panelists, we have a great question here from NAFA, which is really just does ag tech and precision farming fit into your clean tech mandates, or where does it fit into your clean tech mandates?
And I'll go off on that one too. So ag tech. So at BDC, we actually are agnostic, right? So as long as it's innovative tech or services, and you have some reasonability that you are the first ones there, and it's going to be a little bit harder to replicate what you're doing, we're able to come in. I'm working with files right now that are vertical farms, right? So it really doesn't matter from that sense. It will just go back to the revenues as well, right? So if you can show that yes, this is obviously going to work through the lowered expenses. Maybe we've got if you've got romaine lettuce, everyone needs that right now. So maybe that's the way it's going. If we can see that, right, and we see it through your forecast, then absolutely we'll come in at that ag tech, right?
I can follow that up. So SDTC is sector agnostic as well. So we fund all sectors and industries. What our focus is on environmental benefits. So what environmental benefits that you're quantifying? So environmental benefits need to be quantified. So if it's an ag tech and you have some technology that's going to provide air, soil, water, or circular economy solution that's quantifiable, we want to see that. So it's really focused on that, on the innovation and the environmental benefits associated with technologies. We don't have any mandate or focus on specific sectors.
Similar answer from our side. Cleantech is ridiculously diverse. If you look at a pie chart of what Cleantech consists of, and it's all broken up, you'll go blind with all the colors. It's incredibly, and it absolutely includes ag tech and precision farming. I will provide a caveat though. So we at RBCx are looking for, as Jennifer was mentioning, proprietary innovative technologies. So if you're buying, I'll call it a franchise, and I know there are, like from vertical ag, there are some like franchise opportunities. There's a developer with a unique ag tech vertical farming solution, and they're selling it off to various users who are, their prime business is growing crops versus creating new ways of growing those crops. So the new way of growing the crop is the innovative proprietary technology. And if the primary business is producing vegetables or leafy vegetables or whatever, then that's not a fit for RBCx. That would be a fit for RBC's agricultural teams to look at. So there's a home for it at RBC, but it's not an RBCx home. Hopefully that helps.
No, fantastic, everybody. Zach, do you have another question from the
Yeah,
audience?
there's actually a couple of interesting questions that just kind of came in the chat here, Chase. One of them from the RBC team. Can anyone tell us a little bit about the new Clean Technology Invest tax credit proposed in 2022? And how does that compare to the US IRA? Are you guys familiar with this file? Go ahead.
I can go with that one if no one else wants to.
Please take it. Yes.
You want to run away from this one, maybe. Canada has come up with, announced in the fall economic statement and previously talked about in the previous budget. So the next budget's April of 23. So there's been commitments to introduce tax legislation that will act as an investment tax credit in 3 categories. So like you might be familiar with SHRED, and the wonderful thing, one of Canada's competitive advantages is our SHRED program, where we have cash refundable. So if you're not making a profit, it doesn't matter. You get back about 30% of what you put into R&D in Canada. And that's not just hard costs, it's soft costs. So it's a wonderful thing for Canada to have that sort of solution for R&D. Well, this is for clean technologies, and there's 3 buckets. The easier ones to identify are carbon capture, utilization, and storage, and hydrogen. A little bit, well, maybe it's not that difficult, but the title for the 3rd one is Cleantech, but it really is renewable energy, solar, wind, geothermal, energy storage, and hydrogen transportation, in essence. And all 3 of these groups have a minimum of 30% cash back refundable investment tax credit. So this is a really exciting thing. It doesn't go to the clean technology company, it goes to the purchaser of those technologies. So what it means is, often you'll be talking to purchasers and say, I'd be interested in, buying your product, but this is a lot of money, and I've got to stay with the tried and true. Well, all of a sudden, you as a seller of a clean technology can say, whoa, wait a minute. Have you looked at the investment tax credits once they're passed in April? And you could get cash back for 30% and up CCUS could be higher than that, and hydrogen too, depending on the circumstances. So could really reduce the capital costs and could make it competitive with some legacy system that isn't as clean. And if you factor in any of the greenhouse gas emissions that will be abated, which are going to directly cost some businesses, it can become very attractive. So this is a huge step forward in Canada, and something a number of us have been advocating for quite a while. So we're really excited about it. However, here's the but. There's always a but. Relative to the Inflation Reduction Act, and forgive that name, it was something that allowed them to get it passed in government. It's really the Cleantech Act or Climate Act in the United States, but it's called the Inflation Reduction Act, or IRA. It is incredibly broad in its scope. It is bringing directly $370 billion in credits to the space without any cap. So that's just what they've notionally allocated as a potential funding that could go to it. And it is all manner, shape, and form of technologies. So the Canadian one is fairly narrow. The American one is much broader. The American one has very big dollars, and it's not just, the typical, well, it's the United States, so it'll be 10 times bigger than us. It's dramatically bigger than what Canada is expecting. And it's the big thing that they've got there. So one, it would be great if the clean technology definition was broadened. And so there are groups advocating in Canada before this budget to try to get it broadened. So it's not just renewable energy, energy storage, some hydrogen transportation solutions, but they have a production tax credit. And the production tax credit is for the producer. Now, here we're talking about the clean technology company, where the producer can get cash back investment credits based on what they produce. How many widgets do they manufacture? And there's nothing in Canada right now on that basis. There was a hint of it in some government correspondence. So again, some are advocating for that. And if you're interested in advocating for it, please go to the Canada Clean Tech Alliance website. They're looking for signatures right now for that. But there's a big difference between what the Americans are doing. Now, the Americans don't have a tax on carbon, which we do in Canada for heavy emitters, industrial emitters, and energy producers. So we do have that, making it more economic for people to invest in clean technologies. That price is going to go, or is expected to go by 2030 to $170 a ton from $50 today. So that is a bit of an advantage we have in Canada. So when you look at those two programs, you kind of have to factor in the implication of a carbon tax in Canada. I hope that helps. I hope I didn't
Thank you, Peter.
confuse everybody.
I love it. I don't know if anybody else has anything to add on that, because I know you guys just got a glimpse into our last Clean Tech call that we had with our team, which is always fantastic. But yeah, Jennifer, Jean-Luc, I don't know if you have anything. If not, I can hop into the next question from the audience.
I'll just say one thing on the SHRED tax credit. It may or may not have implications to your stacking. So SDTC as a funder of grants, we have stacking limits with other public funding sources. So a project can't have more than 75% of their project cost with public funds, including ours. And SHRED might play into that. So it's just something to be aware of.
Awesome. No, thank you guys. And so next question from the audience, how do each of you perceive companies that have bootstrapped versus companies that have outside investors?
Yeah, I'll take this one to start. First of all, when we see a bootstrap company, we're always impressed because we know the amount of work and dedication it takes at that early stage to bootstrap a company. But when we're perceiving them and looking at it from a non-dilutive financing perspective, it's really going to come down to how much you're burning. If you're a bootstrap company who's been able to keep expenses managed all the way through, and you're burning, let's say $50,000 over the year or $75,000, if we're going to come in and provide, let's say, $350,000, well, we're giving you, 24 to 48 months of runway. And that looks really good. So we're actually really supportive of those ones. When it comes to companies that, let's say, have a very high ceiling or are very capital intensive and they're burning $150,000, a month, well, if we're going to come in and provide $350,000 in capital, well, we've given you 2.5 months, and we're going to be right back at the same place raising that capital. So if you're a really capital intensive company, it's really good to have other capital partners involved so that everyone can see, okay, there's a lot of people coming to the table here, and it's not just going to be on one party to provide this large amount of capital to sustain your burn. So that's kind of how we'll perceive it a bit. Now, obviously, it's from 10K to 150K, and every scenario is different, right? But in a nutshell, that's how we would review it.
Awesome. And I think Jennifer already spoke to this. Oh, sorry, Peter.
Oh, yeah. So for Bootstrap, so
Yeah.
yeah, that's it's great to bring any sort of other funding sources to your project. So for the seed fund, like I said, we don't accept Bootstrap as matching funds. It's only equity, but of course you need the balance of the funds to complete your project. And for the startup scale up, Bootstrap is eligible for matching funds.
When we're talking about credit cards or shred finance, there's no implication. Bootstrap's great, and Bootstrap, like, net invested capital is really the measure. So if the founders have put in, I'll make a silly example, $1,000, and they want to borrow 500,000, that's a little disproportionate. The amount of stake in the game that those parties have provided, despite sweat equity. I get sweat equity, but if the founders have put in $200,000 and they're looking for 200,000 in credit, well, that's not silly. That shows stake in the game. So it's net invested capital we care about. Now, just on that credit card side, I know that sounds like a funny product and not a very sexy one, but that is usually the very first form of credit a company will get. And I would encourage you, if you're looking at getting one, and sometimes you should be putting everything on your personal cards. You shouldn't be guaranteeing that personally if you're going to have a diverse cap table. And so RBCx has some solutions, and we have some more coming. I can't really take the rabbit out of the bag on that one, but we have some more coming, and I would encourage you to think about that one. And then the shred finance one is a good one. If you're looking for, this is a little bit further along the development path, but I know people love to talk a little bit about venture debt. If you're raising capital from VCs, venture debt is this wonderful way to complement equity that's been raised from venture capital firms. And it is relatively patient. I'll say it could be 1 year interest only and amortized 3 years thereafter. But the premise is it's a venture-backed business. So we will be looking to see North American VCs that we have some comfort with, like BDC. It's got a great venture capital group that we know have the capacity to continue to fund. We can partner with, but we'd also be looking for other VCs like Evoke's an active one in Alberta, or others that we can rely on to have good communication with, honest, open relationships, and we can work with the business as it continues to burn. These are almost all burning companies. They've got negative cash flow, but we're working with them. But in that case, Bootstrapped isn't going to work because it just doesn't fit the model at all.
I'll put in a shameless plug if anybody's curious about venture debt. There's a great TNT session, slightly biased on this, from about probably 6 to 9 months ago, where we had one of our directors on our credit advisory team do basically an hour crash course on venture debt. I think you can find it probably on TNT's YouTube page. So just my shameless plug there. And so I know we're running relatively low on time, and there's one last question from the audience here that I want to ask the panelists here. And so, how are you each championing change in the industry? So, changing government mandates and further support for early stage SMBs. I know a bit of a loaded question there.
I can go first if you want on that one. So a bit of a hot potato. I made allusion to the Canada Cleantech Alliance earlier. I should disclose that I'm the treasurer of the Canada Cleantech Alliance. I'm also the chair of the Ontario Clean Technology Industry Association. So what I didn't say at the beginning in my introduction, I should have. Yes, if you've got your camera on, I'm a gray-haired guy, but I'm a career commercial corporate banker, but I'm a lifetime environmentalist. I really care about this stuff. So my personal commitment is also in the space. And so we are, those groups are advocating for the changes we were talking about, specifically related to investment tax credits and manufacturing tax credits, to try to make it better. Advocated during COVID when funding was not coming to the clean tech sector. And in fact, shred funding dried up. Shreds weren't being processed. So I encourage you to be active and involved. And so that'll be my answer to your question.
I'll try and follow that up. I obviously I don't have quite the amount of impact that Peter has had. It's really impressive, and it's always nice to see, a longtime commercial corporate banker also doing it from the other side, right? Championing the clients and not championing the bank. So that's awesome, Peter. Thank you for doing that. And for me, I'm still, working my way up through the industry. Hopefully one day have 50% of the clout that Peter has. But for me, it's personally just about helping each individual entrepreneur. And if I can't do something, I'm going to tell them what I need to do or what I need to see so that I can, and make sure that they've contacted everyone else within the industry that I know of, right? It's, again, that whole thing about turning over every stone to try and get every company that's worth it launched, right? And even if I can't do it yet, let's try and work all together to get this going. And that's, again, shout out to Startup TNT, because they're really doing a lot of hard work to get everybody involved.
Yeah, and I'll just follow that what Jean-Luc said. So for SDTC, the creation of the ecosystem team was one thing that we did to sort of reach into all of the areas of Canada that are less represented, like obviously the big cities and also the lesser represented areas. So we really focus on people in place as an organization. So we're looking for all the entrepreneurs everywhere in Canada, and we like to remain flexible in terms of we go where the market is going in terms of our funding, because we fund those people that are getting other investment, that have commercial partners. And we have that ecosystem team out there in market, always trying to meet people and help them and support them, to bring them into our funding streams or direct them to other areas where they could be successful if they don't necessarily meet our mandate. So that's how, and we also build and maintain our network of other funders and other partners in order to support our entrepreneurs, because this really is about the people.
Oh, fantastic. And so I know, thanks everybody for those detailed answers. I know we're coming up on time in just a couple minutes here. I do have one final question from the audience that I can throw out to everybody if you just have a quick 30-second soundbite on it. And so the question is, with the word recession being thrown around, whatever your thoughts on that may be, whether we're in it or heading for one, do you see a shrinking of liquidity for startup funding?
My answer is no, not for clean tech. Clean tech is a sweet spot. You got Inflation Reduction Act, investment tax credits in Canada. We've got extreme weather events all across our country. It has not stopped here. People are continuing to raise. Valuations have come down a little. Maybe that was overdue.
Yeah, same here. There's been no internal talk about, especially at that entrepreneur startup stage, because that's where we're going to see some real return on some of the investments we make, right? We're at that early stage where we're still just, an idea and trying to flesh it out in the market. So we're trying to make that happen. So it's a lot different than adding on an additional, $10-20 million to a company that's just raised 100 million, right? We're really making an impact and change on these companies, and they can grow into something much bigger than they are now.
Yeah, and I'll just follow that with saying STC is just trying to remain flexible into different situations that entrepreneurs are faced with. And we're also increasing our funding goals in the coming years, trying to deploy even more capital out into the clean tech space.
Fantastic. I think that was the answer everybody was hoping to hear. And with that, I mean, I'll say my final 2 cents before passing it back over to Zach, as probably close out the hour here. But thanks everybody, the audience, for joining today. It's always fantastic to see these. Thanks to each of the panelists. Your expertise and your time is very appreciated and very valued, especially helping out the Prairies tech community, especially in the clean tech sector. I will say, final shameless plug from me. If you're coming out to a happy hour tonight, to one of the TNT happy hours across the Prairies, come and track down any, we're going to have people in 3 of the regions. Unfortunately, nobody in Saskatchewan today, but come track us down, have a beer with us. We'd love to chat further on this topic, have a one-on-one conversation, as well as we can give you some information on a dilutive event that RBCx is hosting coming up in a couple of weeks. Won't be too shameless about that one here. We can chat about it tonight, but over to you, Zach.
Hey, thanks so much, Chase. Thanks, Peter. Thanks, Jean-Luc. Thanks, Jennifer. Everyone on the call today, your organizations are partners and sponsors of Startup TNT. They've all helped out a lot of the companies that we've invested in and have come through our summits. We want to see more of this. And like Chase says, RBC is actually sponsoring part of the bar tab tonight in all of our regions. Come out, hang out, meet some entrepreneurs, meet some bankers, have some fun in the community. Starts at 6 o'clock local time. Thanks, everybody.
And Peter will have the beer from Ottawa tonight to join in.
Will do.
Thanks, Zach.
Thank you.
Thanks, everyone.
Thanks, everybody.
Have a great day.